Investing legend Tom Lee has got a take which might change the way you think about this entire market. Check this out. All right, Tom, I thought a great place to start the conversation is everyone is worried about the AI bubble. We know that AI is real technology. We know the companies are using it, but people still think that there's too much spending going on. There's this big bubble that's going to pop. The world's going to end. Stock market's going to crash. What do you think?
I mean, if we're measuring bubbles based on like risk reward, we're pretty far from it, because in 1998, September, which is similar to today because the Fed was on pause and then they started cutting again September 98, Cisco, which was the biggest company at the time, was trading at 56 times forward PE. 18 months later, it got to 210 times. Now, Cisco made a commodity router that had many competitors. NVIDIA today is the singular most scarce company in AI. They make a chip that everyone who is building a premier model needs. It's trading at 27 times forward earnings. Costco trades at 50 times forward earnings and Walmart's 34 times. So NVIDIA is still cheaper than a membership club company. So I'd say that's why we're pretty far from a bubble.
And when you bring that up to people who are skeptical or critical of kind of the AI companies, what is their response to that?
I think people then say, well, there's a generalized stocks are expensive problem. And because I was just in Latin America and that's what a lot of the pension clients said. But to me, the problem people have is that stocks are trying to discount the future. And AI is not only a labor replacement, so we can calculate, job replacement, and that's a use case. But then there's this agentic and super intelligence potential, which creates productivity. So how do we discount that in the stock prices today? I actually think stocks are still cheap. And I know Jensen was in New York recently, met with some analysts, and I think a lot of the takeaways people had is that in the AI world, companies, enterprises that are spending are starting to see payoff on the AI spend, which means spending is picking up. I actually think AI spending is actually accelerating.
Well, it always is funny to me how people are yelling bubble, but the more people who yell bubble, it seems like the less likely we're in one.
Yeah.
Then how do you have a bubble if every time you hear an AI CEO open their mouth, they're like, we can't keep up with demand, right? And then on top of that, the earnings reports are coming out and there's companies that are $1 trillion+ market caps that are like, we're growing faster than we thought we were going to grow. We're driving more profitability with less employees, which means that they're becoming more efficient, more productive. Hence, they should be more valuable, right?
Yeah. Yeah. And you make a key point, because I've experienced 3 bubbles in my 3 decades doing research. The biotech bubble was the most recent. The one before that was the housing bubble. And the one previous to that was the internet bubble. And 3 of 3 times, not only were people denying the existence of the bubble because they could explain it away, but we saw behaviors that were indicative of a bubble. In the biotech bubble, hedge funds, healthcare hedge funds, were funding university projects so they could get in front of the molecule. I mean, if that was like bubble behavior to me. And as you know, in housing, people were doing ludicrous and absurd things. That's not happening in AI. In fact, everyone's so measured in AI today that it doesn't feel like a bubble. There could be a bubble somewhere else in the market, but it wouldn't be.
So you mentioned valuation multiples. And one of the things that a lot of the older crowd who's been around for a while, their kind of brains break and smoke comes out of their ears when I say this, but I actually think maybe you can't use historical valuations the same way that you can today. And my logic has always been the companies are more valuable, but also there's like a monetary premium in stocks now that maybe previously didn't exist. And it's hard to quantify. So I don't know, what are like the comparisons, but the same way you have like inflation adjusted prices, there almost feels like there needs to be like a monetary premium adjusted share, multiple or something.
Yeah. And also people are willfully overlooking that valuations are actually, they're dynamic. From 1940 to 1967, the 10-year went from 2% to 6%. And everyone should say PE should have fallen in that 27-year period. The PE went from 8 times to 27 times. So in other words, as nominal rates rose, earnings accelerated, and so the PE went up. And that was in a time when 70% of the earnings generated were cyclical. Today, most of the earnings is recurring revenue in the S&P, which is higher multiple. And in fact, the 10-year bond is at 4%, it's at 25 PE. I mean, the bond market's expensive. So, yeah. So I think you're correct. I mean, plus in the last 5 years, we had 6 black swans. We had COVID. We had the supply chain bullwhip effect. We had an inflation bubble, the Fed's fastest hikes in history. We had the tariff terrors and U.S. bombing Iraq's nuclear facilities. 6 black swan events. And the market grew earnings during that time. I would argue PE should be higher because we just battle tested the stock market.
Tom Lee from Frontrat thinks we're nowhere near an AI bubble, and the evidence backs him up. Mr. Lee notes that Nvidia makes up about 8% of the total value of the stock market, but brings in 7% of all profits. Tom sees this as a sign that companies are putting real money into AI because we're seeing actual results. What most people miss about the bubble debate is when you look at past bubbles, companies were spending crazy money on things that didn't make profits. But AI is different. The spending matches the returns. Companies aren't just throwing money at AI for fun, they're doing it because the technology actually works. The real story is about what AI enables, not just replacing workers, but creating entirely new ways to do business. Most investors are still treating AI companies like regular tech stocks. They're using old models to price new technology. That's why someone like Tom Lee can look at the same numbers everyone else sees and come to a totally different conclusion. The market hasn't figured out how to value something that could reshape entire industries. I personally don't believe we're in bubble territory because the fundamentals are solid. Revenue is growing, profits are real, demand keeps increasing. As far as I'm concerned, they aren't bubble signs. Recent research shows that AI spending has become so large, it's actually driving significant portions of economic growth, matching or exceeding consumer spending in some periods. When the infrastructure you're building becomes a meaningful part of the entire economy, again, calling it a bubble misses the point completely. And there's something really interesting about bubble psychology. The fact everyone keeps scrambling about an AI bubble actually signals we're probably not in one. Tom Lee talks about seeing 3 major bubbles in his career: biotech, housing, and the internet boom. In all 3 cases, people denied problems existed and did reckless things. Recent analysis shows that while some executives worry about AI overinvestment, the behavior we're seeing doesn't match past bubbles where investors acted irrationally. Real bubbles have a pattern. People stop asking questions. They justify insane behavior. They throw caution out the window. Think about the housing crisis. People bought homes they couldn't afford and nobody blinked. In the dot-com era, companies with no revenue went public and shot up in value. Investors didn't care about fundamentals. But look at AI right now. Every earnings call gets picked apart. Every spending announcement gets questioned. Investors are constantly worried. That skepticism is actually healthy. It prevents the kind of blind enthusiasm that creates real bubbles. Recent surveys show that companies investing meaningful amounts in AI are reporting positive returns across multiple areas like productivity and innovation. The fundamentals support the spending, plus industries are seeing real productivity gains. Software development accelerating multiple times, companies automating significant portions of work, and getting strong returns on AI investments within months. When you have fear in the market and strong results in the business, that's usually the safest place to be. The people yelling bubble are actually creating the safety net. Their caution prevents the reckless behavior that causes real bubbles. Of course, this isn't financial advice, it's just my opinion, but what we're watching is a massive technological shift happening while everyone stays nervous about it. That nervousness is exactly why I think this isn't a bubble. Real bubbles happen when fear disappears and greed takes over. Picture this: a potential client searches for what your business offers and your YouTube video appears. Before they've even booked a call, they've built trust with you, turning them into a warm lead. That's why our clients are hitting $100,000 months, because YouTube turns attention into authority. If you run a business, book a call and I'll show you exactly how to make this happen.